This tutorial is aimed for finance students in how to deal with partnerships in taxation. So, what is a partnership? Under the partnership tax rules, a partnership is not a single trading tax entity. Each partner must be treated as though they are a single sole trader. Partnerships must submit a tax return to the HMRC. An example of this form is obtained from the HMRC website. This provides information on the profit and loss statements for the period year end. This can also be used to claim capital allowances. So let's have a scenario. Meet Wayne and Jane. They both make an annual profit of £100,000. They both agree that they should receive a salary of £30,000 and they have a 5% interest on capital. And the capital balances are for Wayne £70,000 and for Jane £65,000. The profits of £100,000 are to be split 70% in Wayne's favour and 30% in Jane's favour. This profit is split before any tax adjustments are made. So at the year end, they both receive a salary of £30,000. There's a 5% interest on capital. So for Wayne, this is £70,000 times by 5%, which comes to £3,500. And these two rows are then totaled up as a result. The next step is to calculate the profit remaining. So for Wayne, this is £100,000 profit minus £66,750,000 times it by 70% of his share of the profits, and this comes to £23,000 and £275. The next step is to calculate how much each partner is entitled to of the profits. So for Wayne, for example, this is £33,500 plus £23,275 equals £56,775. So as a result, this is Wayne and Jane's profits, which is then taxed individually. What happens if there is a change to the profit sharing ratio? This may occur if a partner is being admitted into the partnership, a partner leaving due to death or retirement, but as long as there's one partner common to the partnership before and after the change, the partnership will continue as normal. So Tom and Lily are in a partnership. They make a tax adjusted profit of £20,000. Up to the 30th of June, the profit sharing ratio was 3 to 2 in Tom's favour, with a salary of £3,000 and £2,000. However, from the 1st of July, the profit sharing ratio changed from 2 to 1 in Tom's favour, with a salary of £10,000 and £5,000 respectively. So first of all, we must calculate the salaries. This is apportioned to 9/12 of the year because the current profit sharing ratio arrangement starts on the new trading year on the 1st of October to the 30th of June. Then we must calculate the profits, which is also apportioned 9/12 of the year, which gives you £15,000. The balancing figure is, as a result, is 11,250, which is then apportioned to a ratio of 3 to 2 in Tom's favour. On the 1st of July, in the new profit sharing arrangement, salaries of £15,000 is apportioned to 3/12 of the year, which is further split between Tom and Lily on a 2 to 1 basis. Profits are also apportioned to 3/12 of the year, leaving a balancing figure of 1,250. Then the allocation of profits for Tom and Lily are calculated by adding together each column. Therefore, the profit attributable to Tom is £12,333 and to Jane it is £7,666. So another scenario is where Wayne and Jane have been partners since the 1st of July 2012, with their accounting year end on the 30th of June every year. On the 1st of July 2014, Tom joins and all the profits are shared equally. Their tax-adjusted trading profits are, for the 30th of June 2013, £15,000, on 2014 £10,000, and in 2015 £20,000. The first step is to allocate the tax-adjusted profits. In the first 2 years, it is split evenly between Wayne and Jane. Tom will be treated as commencing on the 1st of July 2014. The second step is to calculate each partner's profits that are assessable. So, Wayne and Jane will both be assessed on the start of their trading period. In this example, it is the 1st of July 2012. In the first basis period, the individual profits of 7,500 is apportioned to 9/12 of the year because trading began from the 1st of July to the UK tax year end on the 5th of April. In the first tax year, on the year ending 30th of June 2013, Wayne and Jane individual profits of £7,500 are assessable profits. It is very important to know that 9/12 of £7,500 has already been assessed in the previous year. Therefore, both Wayne and Jane will have an overlap profit of £5,625. In the year ending 30th of June 2014, Wayne and Jane have an individual assessable profit of £7,000. In 2014, it is £7,500. So, how do we deal with Tom in the partnership? Well, his commencement begins on the 1st of July 2014 and therefore is assessed from this date. Once again, Tom receives an adjusted tax profit of £7,000. However, 9/12 of it has already been assessed in the previous tax year. Therefore, he'll have an overlap profit of £5,250. So in summary, we have assessed what a partnership is, how to calculate trading income assessable for each individual partners, what happens if there is a change in the profit sharing ratio, and what happens if there's a new partner admitted into the partnership. In the next tutorial, we will look at how to deal with loss-making partnerships, how to deal with capital allowances, and analysing limited liability partnerships.
Created using Powtoon.